Hey traders, welcome to Master the Market, where we help you become a market master. In today's video, I want to talk about the stock market crash of 2025. Now, realistically, no one knows if the stock market is going to crash and when it's going to crash, but things have definitely been a little bit choppy and a little bit dicey over the past couple of weeks. So in this video, because most traders will end up losing money from a market crash, we're going to cover the things that you can do differently in order to actually capitalize on a market crash and to set yourself up to make even more money when the market does recover. So I want to take a quick look here at SPY before we go into some of these tips and take a look here at the daily chart. We can see that SPY has sold off from about $613, the all-time high, to currently today being at about $583. A relatively small pullback of just 6 or 7%, I believe. But we have many individual stocks that are significantly off of their all-time highs. If we take a look at Tesla, for example, Tesla, of course, is a market leader. And despite being a market leader, even though the S&P is really only down about 5 or 6%, we have Tesla, which is down all the way from a high of 488 a little bit over 3 months ago to now just being at $277. We also had a pretty big sell-off in NVIDIA. NVIDIA is also, of course, a big market leader. And we can see NVIDIA is currently down at about $117 from its 153 all-time high. So again, even though things in the general market with SPY are not too far off of the all-time highs, we have plenty of individual stocks that have sold off pretty significantly, and that's what's leading a lot of people to think, this could end up being a bigger sell-off in the market. So the first thing that I want to talk about that you can do to set yourself up to profit or to capitalize on a market crash, or even if we just have a slightly bigger pullback than we're currently experiencing, is to use options. Now, this is only going to apply to you if you are currently invested in the stock market. But for example, let's just say that you have 100 shares of NVIDIA. I want to jump over here to my Robinhood screen because this is going to be the most simple, straightforward way that I can show you this. And what we're going to be doing here for this example is selling a covered call. Covered calls allow you to profit if a stock is trading sideways, if a stock is selling off to the downside, or even if a stock is slightly moving higher. Really, the only time that you don't want to be selling covered calls is if the market is very strong and if the market is going to have potentially a strong move to the upside. Now, because an option contract represents 100 shares of the underlying stock, in order to sell a covered call, you need to own at least 100 shares of the stock that you're trying to sell a covered call for. That can be, SPY, it could be NVIDIA, it could be Tesla, Google, Amazon, and so on and so forth. And what you would want to do is pull up that stock, go to the options chain, go out a couple of weeks from the current date, and you're going to look for a strike price to sell a call for that you believe the stock is going to stay below. So if we take a look at the chart for NVIDIA, and we believe that because of the choppiness in the market, we think that NVIDIA is going to stay below $125 per share. We would sell that 125 call for a few weeks out, and that's going to allow us to then collect, in this example, $200 in premium as long as the price of NVIDIA stays below 125 by our selected expiration date about 2 weeks away. After that call expires, you're simply able to repeat the process over and over by selecting a further out expiration date and a different strike price, continuing to hold on to your original investment, and being able to over and over collect that premium as long as the price stays below your selected strike price. Now, the only risk for a covered call is really that the stock ends up having a very bullish move to the upside. And in this case, it's actually not going to add more risk and more potential for a larger loss. The only risk really is that you're going to miss out on some potential upside. So again, we're using that 125 strike price for this example. I'm going to go ahead and draw a line at 125 to represent that strike price. And let's just say that within the time frame that we sold our covered call till our expiration date, there ends up being a big spike up in the market, and we have a big spike up in NVIDIA as well. And NVIDIA spikes all the way up to $140 per share. So now our covered call that we sold is $15 below the current strike price of NVIDIA. That is essentially the biggest risk that you're going to face with a covered call. And what would happen in that situation is that we're not going to lose any money. We're still going to collect that $200 in premium. However, we're going to be required to sell our shares at $125 since that is the strike price that we selected. And that means that we're going to miss out on $15 in potential profit since the price is now all the way up at $140. That's why this is not the type of strategy that you want to utilize when the market is strong. But when the market is choppy and we're experiencing a pullback or a potential market crash, selling covered calls is a great way to collect some premium and make some extra money on your current positions, ideally without having to sell any of your shares. Now, the next thing that I want to talk about in order to maximize your potential returns with a stock market crash is going to be to diversify your portfolio. Obviously, if you've been investing or trading for a while, you've probably heard about the importance of diversifying your portfolio, but I want to give you a quick example of why this is so important. If we take a look here at the heat map for the market, over the past day, we can see that today the market is recovering a bit. However, if we zoom out and we look at the 1 week performance, we can see that for the most part, it's been pretty much a bloodbath. We have Nvidia down about 10%, maybe GEO down 9%, Apple down a bit, Tesla down 5 more percent, Meta down 2.6%. And a lot of these numbers are going to increase even more if we look at the 1 month performance. We can see Google down 13%. We have Tesla down in the past month 28%, and so on and so forth. So the importance of diversifying your portfolio is you're not going to be putting all of your money into something like Tesla that can potentially sell off 20 or 30% in a 1 month time frame, causing you to lose 20 or 30% of your entire portfolio. So just by having half of your portfolio in Tesla and the other half in Apple, that's already going to cut those losses down in half, just because Apple was able to perform well over the past month while Tesla was having a pretty significant sell-off. So you can see how this can be really beneficial when you split up your investments into many multiple smaller investments, especially when the market is experiencing high volatility and the market is starting to sell off. Now, to take things a step further, if we look at the 1 week performance, again, we can see that for the most part, it's been pretty much a bloodbath. But we can see here that there are a few different sectors that in general have been outperforming the market. We can see there's been a lot of green and a lot of strength in the healthcare sector. And we can see there's also been a lot of green and a lot of strength in the consumer defense. So stocks like Walmart, stocks like Costco and Target, stocks like Pepsi. Then we have healthcare stocks like Eli Lilly, J&J, MRK, ABBV, and so on and so forth. These have all kind of been outperforming the market while the market has been selling off. So by diversifying your portfolio into different sectors and specifically into sectors that are outperforming the market when the market is selling off, that's going to set you up nicely to minimize your losses when the market is moving lower and to maximize your returns when the market starts to recover. All right, now moving back over here to the chart for SPY, the next tip that I want to talk about is going to be to dollar cost average your way into a position when you're trying to invest while the market is selling off. Dollar cost averaging is simply slowly adding money into the market rather than buying all at once. This is really important because realistically, it's very, very difficult to buy at the exact bottom of a sell-off or the exact bottom of a pullback. So odds are if you're trying to do that, you're most likely going to end up being a little bit too early, or you're going to be a little bit late and you're going to miss out on some potential profit. So rather than trying to be a perfect trader, it's best to just slowly scale your way into your position. That means that if the market has pulled back maybe 5%, you start to invest 10% of what you're looking to invest initially. Then a few days later, you're going to invest 10% more. A few days later, 10% more. A few days later, 10% more, and so on and so forth until you're at your maximum position size. This is going to allow you to add shares as the price is moving lower or as the price is moving higher, giving you hopefully a pretty solid average cost for your overall investment. And on top of that, if you're investing based on a dollar amount, it's going to allow you to add more shares as the price gets lower, which is going to reduce your average cost overall even more. And again, that will set you up nicely to maximize your returns when the market does recover. Now, realistically, with any investment, you should be doing something along these lines in order to scale in and out of your positions. But in my opinion, it is especially important to do so when you're trading something that is a little bit more volatile. So if you're in an individual stock, for example, something like Tesla, or if you're trading something like UPRO, for example, UPRO is another great way to maximize your returns when the market does recover. And the reason for that is because UPRO is going to be the 3 times leveraged ETF for the S&P 500. So that means, simply put, that if SPY moves up 1%, UPRO is going to move up 3%. Obviously, the same thing is going to be true for the downside as well. So there is going to be a little bit more risk when you're trading UPRO when compared to SPY. But if you wait for the market to bottom out, you wait for it to start to recover, start to form some higher lows, by buying into something like UPRO or like TQQQ, which is the 3 times leveraged ETF for the NASDAQ, that's going to, again, really help you to maximize your returns when the market does begin to move higher, because these are going to be more volatile. They're going to outperform simply because of that leverage, and they're going to allow you to make, 30% while the general market is maybe only making 10%. So if you're someone that doesn't mind a little extra risk, these leveraged ETFs are great to pay attention to when we're getting a serious pullback in the market or even potentially a market crash. All right, so those are my main tips to deal with a stock market crash, to be able to capitalize on that market crash and to, again, set yourself up nicely to really be able to maximize your returns when the market recovers. I hope you found some value in this video, and if you did, please make sure to give it a like and subscribe to the channel. Whether the market crashes in 2025 or whether it's right back up to all-time highs, at Master the Market, our goal is to trade strategies that we can utilize in any market condition, and we teach those strategies in the Day Trade Bootcamp, and we also utilize them every single day in the Market Master group. So if you're interested in either of those programs, you can click down below in the description to learn more and get signed up. Anyway, thank you again for watching. I hope you enjoyed, and good luck with your trading.